Welcome back to Talk Tickers. We are back at the desk, sifting through the noise, reading the transcripts, and digesting the earnings call so you don't have to.
That's the mission. The goal is always to filter out that, the corporate fluff and get straight to the strategies that are actually moving the needle.
Today, we are turning our attention to FNB Corporation, ticker FNB. And I have to be honest with you, right out of the gate, when I saw a regional bank on the schedule for today, I kind of groaned.
Why the groan?
Because the narrative out there is just brutal. You open the Wall Street Journal, and it's all doom and gloom. Commercial real estate is collapsing, office towers are empty, deposit costs are just skyrocketing.
It feels like walking into a minefield.
Exactly. But then I looked at this print from yesterday morning, January 21st, and this story, it doesn't fit that narrative at all.
It really doesn't, and that's exactly why we're talking about it. The theme for FNB this quarter is what I call boring is beautiful. While, the rest of the sector is panicked about the Fed or terrified of their own loan books, FNB just delivered what they called a self-help quarter.
Self-help. That usually implies like a turnaround situation or a company fixing some big mess. But that's not really the case here, is it?
Not in the distress sense, no. It's self-help in the sense of agency. They aren't just sitting on their hands waiting for Jerome Powell to cut rates to save their margin.
They're being proactive.
They are actively restructuring the balance sheet and using tech to manufacture their own returns, regardless of what the macro environment is doing.
Proactive versus reactive. I like that. But okay, let's validate that premise with the actual numbers. The scoreboard is the scoreboard. How did they do?
The scoreboard was decidedly green. Let's start with the bottom line. Operating earnings per share, the EPS, came in at 50 cents.
50 cents. Okay, contextualize that for me. What was the street expecting?
The consensus was 41 cents. So they beat by a solid 9 cents. And look, in the mega cap tech world, a 9-cent beat might be a rounding error. But in regional banking,
That's a huge spread.
it's massive. Usually these banks trade on pennies. A beat of that magnitude suggests something fundamental is working way better than the analysts modeled.
That's almost a 20% beat on the bottom line. What about the top line? Was this just cost cutting or was revenue driving it?
It was a bit of both, but the revenue quality is high. Revenue came in at $457.78 million.
Okay.
Now, if you want to be a pessimist, you could point out that consensus was $457.87 million, so they technically missed by a hair. But effectively, it was in line. The real story isn't the total revenue, it's the margin.
The net interest margin. NIM.
Exactly. The NIM. In a world where banks are getting squeezed because they have to pay you and me 4 or 5% for our savings accounts, FNB's margin actually expanded.
It went up.
It hit 3.28%. That's up 3 basis points from last quarter and up 24 basis points from a year ago.
That is the statistic that jumped out at me. Everyone else is seeing margin compression, and FNB is widening the gap. How is that even possible? Are they just not paying their depositors?
No, they're paying market rates where they have to, but they are managing the mix of their assets and liabilities incredibly well, and the market saw it immediately. The stock popped about 2.8 to 3% right after the news.
A very constructive response.
Very. Traded up near 1780.
So let's dig into the how. You mentioned this was a self-help quarter. You don't get a 9-cent beat just by saving money on paper clips. They made some big structural moves.
They did. The headline move here was a balance sheet rotation. In December, so right before the quarter closed, they took about $200 million of residential mortgages and moved them to held for sale.
Okay, let's pause on that. For anyone who isn't a bank, treasurer moving loans to held for sale effectively means you're planning to dump them. But these were performing mortgages. Why get rid of safe paying loans?
And that's where the strategy gets really interesting. Yes, those loans are safe. But in banking, capital is a finite resource. You only have so much money you can lend against your capital base.
Right.
Those mortgages were likely low-yielding fixed-rate loans.
Yeah.
Management explicitly called them out-of-market loans.
Out of market meaning what? They didn't have a broader relationship with the borrower.
Exactly. These were customers who had a mortgage with FNB, but they didn't have a checking account. They didn't have a credit card, no wealth management account. They were just single product customers.
So they're clogging up the balance sheet. They're taking up capital that could be used somewhere better.
Precisely. FNB is clearing the decks. They want to take the capital that's released from selling those sleepy mortgages and redeploy it into commercial and industrial lending, C&I.
C&I loans, business loans.
Right. And business loans are superior in this environment for two reasons. One, they usually have floating interest rates. So if rates stay high, you make more money. Two, and this is the crucial part, they come with operating accounts.
Huh.
When you lend a business $5 million, they usually put their payroll account and their operating cash with you.
So you get the loan yield, plus you get the deposits. It's a double win.
It's shifting from a transactional commodity product, the mortgage, to a relationship-based business model. That's how you expand margins when everyone else is shrinking.
But wait a minute. If they are pivoting to business lending, doesn't that expose them to the other big fear in the market? Commercial real estate. We can't talk about a regional bank without talking about the CRE doom loop.
That's the elephant in the room. But FNB seems to have the elephant on a leash. Their CRE concentration is sitting at 197% of capital.
Why does that specific number 197 matter? Is that just an arbitrary benchmark?
Oh, it's very specific. The regulators, the Fed, the FDIC, they have a bright line at 300%. Once a bank's CRE exposure crosses 300% of its capital, the regulators basically move into your spare bedroom.
So they're all over you.
They scrutinize every deal, they restrict your growth, they increase your capital requirements. It's a penalty box you do not want to be in.
So by being at 197, FNB is well below the radar.
They have a massive runway. While their peers might be sitting at 280 or 290, terrified to write a new loan because it might trip that wire, FNB has capacity. They can go on offense.
Which means pricing power. If you're the only bank in town with capacity to lend.
You dictate the rate. You pick the cream of the crop and you set the terms. That is a massive competitive advantage in a credit-crunched market.
Speaking of credit, though, capacity is one thing, but quality is another. Are we seeing any cracks? Are the office towers in their portfolio going vacant?
Surprisingly, no. And I use the word surprisingly because the macro narrative says everything should be falling apart. FNB's net charge-offs were only 0.19% annualized.
19 basis points. That's historically low. That's almost nothing.
It is. That's $16.4 million. And looking forward, the non-performing loans or OEO, which is foreclosed real estate, are at a multi-year low of just 31 basis points.
So despite all the headlines about the office apocalypse, FNB's credit metrics actually improved this quarter.
They improved. It seems counterintuitive.
How are they doing that? Is it geography? The type of lending?
I think it's granularity. They aren't holding the $100 million note on some downtown skyscraper that's half empty. They're lending to middle market businesses, medical offices, logistics centers, the parts of the economy that are actually doing okay.
They've avoided the big flashy disasters.
Exactly.
Okay, so the balance sheet is clean, credit is holding up. I want to pivot to something that sounded a bit buzzy to me on the call, but I want to get your take on whether it's real. The tech story.
Ah, yes.
Every bank CEO says they are a tech company with a banking license. Usually it's just nonsense. But FNB spent a lot of time talking about their common app and something called Payment Switch.
I agree. Usually it is fluff. But here, I think it's actually a strategic moat. Let's talk about Payment Switch.
It sounds like a utility. Payment Switch.
It's a weapon. Think about the biggest barrier to changing banks. Why do you stay with your current bank? Is it because you love them?
No, it's because moving is a total nightmare. I have my Netflix, my gym membership, my electric bill, my paycheck. It's all tied to that one account. Moving it all is such a headache.
Exactly. It's inertia. Banks have historically relied on customer laziness to keep deposits. FNB is flipping that script. Payment Switch is a feature in their mobile app that automates that entire process.
So it does it for you.
It allows a customer to switch their direct deposits and recurring payments to FNB almost instantly.
So they are weaponizing convenience.
They are removing the friction. If you make it easy for a customer to move their primary operating account, you win the relationship. And remember, the primary account is the one that gets the direct deposit. That is the sticky, low-cost money that funds the bank.
I see. So instead of just offering a high interest rate to attract hot money that will leave as soon as rates drop,
Right.
they are using tech to steal the lazy money from competitors.
Correct. It's a play for the core operating account. And that pairs with their internal efficiency efforts. They are using AI and data science not just for chatbots, but to automate all the back office processing.
I mentioned cost savings there, right?
They did. They've historically squeezed out 10 to 20 million a year in savings, but they explicitly said they expect higher savings in 2026 because of these tools. And this drives the efficiency ratio.
Let's define that for a second. The efficiency ratio.
Simple concept. How much does it cost you to generate $1 of revenue? FNB is guiding toward the low 50s by the second half of 2026.
And for context, a lot of their peers are sitting in the 60s, right?
Oh yeah, easily. If FNB spends 52 cents to make a dollar and a competitor spends 62 cents, FNB has a massive profitability cushion. That is operating leverage. Expenses grow slower than revenue.
So bringing this all together into the outlook, what are they telling us about 2026? Are they expecting a recession, a hard landing?
They are playing it fairly safe. Their guidance assumes a soft landing. They're modeling 2 rate cuts from the Fed, one in April, one in October.
That feels like the consensus view right now.
It is. And based on that, they are projecting net interest income between $1.495 billion and $1.535 billion. They see mid-single-digit growth in both loans and deposits.
So not explosive growth, but profitable growth.
Exactly. And on the deposit beta, that's the jargon for how much they have to pay customers when rates move, they expect the cumulative beta to hit the mid-30s.
Okay. What's the takeaway there?
The important part is that as rates fall, they believe they can cut their deposit costs fast enough to protect that 3.28% margin we talked about earlier.
Okay, so we have a bank that is growing organically, protecting its margins, and cutting costs with AI. They're generating a lot of cash. What are they doing with it?
This is the capital allocation part of the story. They are sitting on a CET1 ratio of 11.4%. That is a fortress balance sheet.
That's very strong.
And get this, tangible book value per share, TBV, grew 13% year over year to $11.87.
Wow. That is a number that investors should care about. 13% growth in tangible book value in a year that was supposed to be terrible for regional banks. That is real wealth creation.
It absolutely is. And they are returning that capital. They bought back nearly $50 million of stock in 2025. They signaled on the call that they will likely do the same, or maybe more, in 2026.
And a dividend increase.
They even teased a dividend increase, mentioned it was on the table for board discussion this year.
But here is what they aren't doing, which I found really interesting. The CEO, Vince Deli, he didn't sound like he's looking to buy anyone.
Not at all. Management poured cold water on large M&A. It's been 9 years since their last big deal. They were very clear. They prefer organic growth.
Which is refreshing. Usually when a bank has this much excess capital, the CEO gets bored and buys a competitor, usually overpaying and diluting shareholders.
Exactly. FNB is saying, we don't need to buy a messy balance sheet to grow. We can just steal market share with our tech and our lending capacity. It supports the boring is beautiful thesis.
What?
Why take on integration risk when you can grind out a 16% return on tangible common equity on your own?
16% ROTCE is elite. Okay, we've dissected the beat, the strategy, the tech, the capital. Sounds like a very clean story.
It's a very clean story in a very messy sector.
But as always, we can't just leave it there.
Mm-hmm.
We have to translate this analysis into something actionable, or at least something entertaining.
I think I know where you're going with this.
It is time for our not financial advice segment.
And the huge disclaimer here. We are just 2 voices in your headphones. This is for entertainment purposes only. Do not trade on this. If you lose money, please do not call us.
So if you take everything we just discussed, this divergence between FNB and the rest of the pack, there's a fascinating trade setup here.
Okay, lay it out for me.
I call it the data-driven efficiency pair trade.
Sounds sophisticated. What's the play?
You go long FNB, you are betting on the self-help execution. You're betting that they hit that low 50s efficiency ratio and that payment switch actually works to steal those low-cost deposits.
And the short leg of the trade?
Short a basket of what I'm calling analog regional peers.
Define analog for me.
I'm talking about the banks that are still 100% reliant on physical branches. The banks where the mobile app hasn't been updated since 2022. The banks that are sitting on 280% CRE concentration and have no capacity to lend.
I see the logic. You are basically betting on a divergence in operating leverage.
Exactly. As rates stabilize, the rising tide lifts all boats era is over. Now it's about who can acquire customers cheaply. FNB is building a digital machine to do it. The analog banks have to pay up for deposits or build expensive branches.
So FNB's cost of growth goes down while the analog peers' cost of growth goes up, or at least stays high.
Precisely. And if you want a simpler angle, just look at the book value, the tangible book value compounder trade.
Go on.
FNB grew TBV 13% last year. The trade is simply betting that the market eventually wakes up and realizes that boring isn't bad. Right now, FNB trades at a discount because it's a regional bank. But a 16% return on equity shouldn't trade at a discount.
In a soft landing economy, consistent profitability becomes the new growth stock.
Exactly. When the AI-hype stocks eventually cool off, money flows to quality compounders, and FNB is compounding value at double digits.
It's a compelling thesis, again, strictly theoretical, but it highlights just how well FNB is positioned relative to the doom and gloom crowd.
So to wrap this all up, FNB delivered a beat-and-raise quarter. It wasn't flash, it was pure execution. They dumped the low-yield mortgages, they are leaning into business lending, and they are using tech to drive efficiency down to truly elite levels.
Management sounded confident, almost aggressive, I'd say. While others are retreating, FNB is talking about taking market share.
They're playing offense while the rest of the league is stuck playing defense, and in the long run, offense wins.
It usually does.
Thanks for listening to Talk Tickers. We'll see you on the next print. Keep your eyes on the tape.